Hello everyone and welcome on Be Successful, your favorite development channel. The place you always leave smarter than you came. Today we will talk about ETFs. You have probably heard of ETFs at some point. But what is actually an ETF? ETF comes from Exchange Traded Funds and is an index tracking fund that trade on the stock exchange. The tracking feature means that ETFs hold baskets of shares that match the composition of leading stock market indices such as the S&P 500 and FTSE All-Share. You can buy and sell ETFs in real time just like shares. With ETFs, you can invest in shares easily and cheaply and build up assets over the long term. ETFs enable you to invest cost-effectively in entire markets with one security. For example, with a single ETF that follows the MSCI World Index, you could spread your investment over around 1,600 companies from all over the world. The MSCI World Index, which is part of the modern index strategy, is a broad global equity index that represents large and mid-cap equity performance across 23 developed markets countries. It covers approximately 85% of the free float adjusted market capitalization in each country, but MSCI World Index does not offer exposure to emerging markets. The index is allocated into different sectors such as financials, information technology, healthcare, industrials, consumer discretionary, consumer staples, communication services, energy, and others. You can also invest in many other asset classes with ETFs. Owing to this variety, ETFs are the perfect building blocks for private financial investments. Before going further, don't forget to like this video and subscribe to the channel to help the YouTube algorithms and help us to spread the content to other people. If you've never heard of ETFs before, is because they are not a popular product for commission-oriented financial advisors and affiliated banks. Since these advisors basically survive on the commissions paid to them for selling the financial products by the respective fund providers. However, there are no such commissions for ETFs. For this reason, ETFs are currently recommended almost exclusively by fee-only financial advisors. You could rapidly notice a big difference in the total expense ratio, also known as TER. The total expense ratio, or TER, is a measure of the total cost of a fund to an investor. Total costs may include various fees and other expenses. For example, a MSCI World ETF has a TER of 0.2% instead of 1.65% for an active fund. It might not look much, but it makes a massive difference when we look at 20 to 30 years investing period. While the ETFs are relatively unknown to private investors, professionals have been using these in their investments for years. ETFs are a fixed part of portfolios at pension funds and insurances. But the popularity is increasing rapidly. If you read the newspaper carefully, you will see reports on ETFs quite often. Especially, the clients of online brokers are increasingly using ETFs for their investments. Transparency is also very important. Anyone with internet access can search the price activity for a particular ETF on an exchange. In addition, a fund's holdings are disclosed each day to the public, whereas that happens monthly or quarterly with mutual funds. This transparency allows you to keep a close eye on what you're invested in. Say you really don't want to be invested in oil. You'd be able to spot those additions to your ETF more easily than with a mutual fund. Tax benefits. ETFs have two major tax advantages over mutual funds. If you invest in a mutual fund, you may have to pay capital gains taxes, or the profits from the sale of an asset, like a stock, through the lifetime of your investment. This is because mutual funds, particularly those that are actively managed, often trade assets more frequently than ETFs. Most ETFs, on the other hand, only incur capital gains taxes when you go to sell the investment. This means you'll pay less tax on your ETF investment overall. As mutual fund managers are actively buying and selling investments, and incurring capital gains taxes along the way, the investor may be exposed to both long-term and short-term capital gains tax. If you're invested in an ETF, you get to decide when to sell, making it easier to avoid those higher short-term capital gains tax rates. Many people run away from the volatility of the stock market because they fear high losses. However, you can overcome stock market crashes and lower your risks by investing for the long term. The analysis shows that you would always have achieved a positive return if you invested in the MSCI World for at least 14 years, over any period since records began in 1970. Past performance is not a reliable indicator of future performance. This boilerplate warning, slapped on every key investor document, is a reminder that investing always involves risk and that past returns can't just be projected to continue uninterrupted. But while history doesn't repeat, we know that it often rhymes. We know that past returns contain information about risk and can help us make strategic portfolio decisions, just as meteorological data tells us something about our country's climate even though we can't accurately forecast next week's weather. Long-term data helps us tease out the behaviors of asset classes and can be used to assess the balance of risk and return in model portfolios. Armed with our working assumptions, you can use this knowledge to customize our portfolios to suit our expected returns, individual risk tolerance, and time horizon. You can trade ETFs via most online brokers and trading apps. All brokers are regulated by the financial authority depending from country to country. Trading is easy and you can start with as little as $25. Your assets are held on your behalf by a financial custodian company, and you can check your portfolio at any time by logging into your brokerage account. Your first steps should be: 1. Choose your online broker. 2. Open your online investment account. 3. Fund your account with a cash transfer from your debit card. You will be able to invest straight away. 4. Select a diversified ETF that automatically reinvests your dividends. That enables you to take full advantage of the compound interest effect. 5. Set up a regular investment plan with your broker, funded by direct debit, to automate the process on a monthly basis. A golden rule of investing is, don't put all your eggs in one basket. Spreading your risk across stocks, markets, and asset classes is both essential and easy with ETFs. You can ride out and even benefit from market turbulence by combining diversification with a long-term perspective, plus a buy and hold strategy. There are two types of ETFs: distributing and accumulating ETFs. The distributing ETFs transfer cash straight to your investment account as dividend income, where you can withdraw it to spend on the good things in life. The accumulating ETFs automatically reinvest income for you. Dividend income is generated when companies pay out a proportion of their profits as cash. ETFs gather these dividends on behalf of their shareholders and periodically hand them over or reinvest them 1 to 12 times a year. You might expect a dividend yield of about 2% from a broad global index like MSCI World, though that percentage will vary in line with economic conditions. You can achieve a significantly higher yield with ETFs that target high dividend-paying companies if generating a steady stream of passive income is important to you. Accumulating ETFs are the best choice as they automatically reinvest your income back into the fund at no extra expense. This compounds your returns, saves you time, and spares you dealing fees. We will cover this topic in a future video. At the end, I would like to recommend you www.justetf.com, an excellent website where you can search for the best ETF portfolio that will fit your investing strategy. Let us know if we should make another video about how to search for the right ETF using www.justetf.com. Please tell us, what is your favorite ETF investment strategy? Until next time, take care of your money.